Silver has been quiet. Too quiet. For most people, it looks unchanged, unimportant, almost irrelevant. But beneath that calm surface, something is tightening. Forces that rarely align are now pulling on silver at the same time. Not slowly, not gently. History shows that when this metal finally moves, it does not knock, it breaks the door. Businesses feel it, markets react to it. And those who ignored it ask one question too late. How did we miss this? This is not about price charts or short-term speculation. This is about a signal, one that often appears before larger economic stress becomes visible. And once this signal is clear to everyone, the opportunity to prepare is already gone. Now, before continuing, they welcome the audience to AG Market Stress. They speak calmly, like talking to an old friend who has lived through many market cycles. If this kind of thinking helps them stay one step ahead, then subscribing is not about trends or noise. It is about staying informed before decisions become urgent. They ask the audience to leave a comment. From where in the world are they watching today? Which economy feels the pressure first where they live? Silver appears calm. For years, it has traded without the drama seen in stocks, cryptocurrencies, or even gold. Headlines rarely focus on it. Analysts often treat it as an afterthought. To many decision makers, silver looks like a market that has already revealed everything it has to offer. That assumption is dangerous. They explain that stability in markets is often misunderstood. A stable price does not mean a stable system. In many historical cases, the most violent market moves came after long periods of silence. Silver has followed this pattern repeatedly. Unlike popular assets, silver carries a dual role. It is both a monetary metal and a critical industrial input. This alone makes it structurally different from gold. Gold can sit untouched in vaults. Silver cannot. It is consumed. It is transformed. It disappears into products that modern economies rely on. This dual role creates tension that is easy to ignore when prices are quiet. They point out that many investors still rely on outdated frameworks. Silver is often categorized as a speculative commodity rather than a strategic material. This misclassification leads to underestimation of its importance. When risk models overlook real-world demand, blind spots form. They describe how financial media contributes to this illusion. Coverage focuses on short-term price movement rather than long-term structural pressure. If silver does not spike dramatically, it is assumed nothing is happening. But markets do not always communicate stress through headlines. Sometimes they communicate through silence. They explain that silver's market size is relatively small compared to global capital flows. This makes it sensitive to change. When demand increases or supply tightens, the adjustment does not need to be large to create imbalance. Small shifts can have outsized effects. Business leaders often miss this because silver does not sit directly on their balance sheets. Yet it influences costs indirectly. Energy systems, electronics, medical devices, and industrial equipment all rely on it. When silver tightens, it shows up as margin pressure, supply delays, or higher input costs. They emphasize that silver rarely moves in isolation. Historically, it has acted as an early signal, before inflation becomes visible, before confidence breaks, before policymakers react. Silver begins to behave differently, but those signals are subtle at first. They discuss how calm periods encourage complacency. Decision makers assume tomorrow will look like yesterday. Risk assessments remain unchanged. Procurement strategies stay fixed. This is how exposure builds unnoticed. They warn that extrapolating recent calm into the future is one of the most common strategic errors in business. Markets evolve, structures shift, and silver's structure has been changing quietly. They explain that today's environment is different from past decades. Monetary systems are under strain, industrial demand is rising, political intervention in markets has increased. Yet silver is still priced as if none of this matters. This disconnect is the core risk. They clarify that this is not a prediction of immediate price movement. It is a warning about positioning. Those who wait for confirmation often receive it at the worst possible time. Silver does not send loud warnings early, it sends subtle ones, and the question quietly forming beneath the surface is simple. If silver looks calm, but the system around it is not, what happens when that calm finally breaks? They shift the focus away from price charts. Because price is never the beginning of the story. Real market stress starts earlier, when forces that normally act alone begin moving together. They explain that silver is unusual because it sits at the intersection of three powerful systems. Most assets respond to one dominant driver at a time. Silver does not have that luxury. Right now, it is being pulled simultaneously by fear, factories, and policy. This convergence is rare, and rare convergences are rarely stable. They begin with fear. Fear is not panic. It is not headlines or breaking news. Fear is the slow loss of confidence. It appears when people no longer trust the room they're in, when currencies feel weaker, when debt feels heavier, when political decisions feel unpredictable. In those moments, capital looks for anchors. Gold has always been one. Silver follows, but differently. Silver does not absorb fear quietly. It absorbs it while already being used elsewhere. That makes it more sensitive, more reactive. They note that when monetary fear rises, silver demand does not replace industrial demand. It stacks on top of it. This layering effect increases pressure without immediately changing price. Next, they turn to factories. Industrial demand for silver is not theoretical. It is physical, measured in ounces that are burned into products and never returned to the market. Solar panels, electrical systems, medical technology, sensors, and advanced manufacturing all depend on silver's properties. There is no perfect substitute. They explain that modern industrial planning assumes steady access to inputs. Supply chains are optimized for efficiency, not shock. When demand rises gradually, systems adjust. When demand rises, while supply is fixed, stress builds invisibly. Factories do not speculate. They buy because they must. This makes industrial demand stubborn. It does not retreat easily when prices rise. It competes with investors instead of yielding to them. Then comes the third force, policy. They describe how governments and regulators increasingly influence commodity markets. Trade restrictions, environmental regulations, export controls, and financial rules all shape how metals move. These actions are often disconnected from market realities. Policy does not ask whether supply can respond. It assumes it will. They explain that silver production is not easily expanded. New mines take years. Environmental approvals take longer. Capital investment is cautious after decades of underperformance. Yet policy decisions continue to assume flexibility that does not exist. This creates friction. Fear pulls capital toward silver. Factories pull material into production. Policy restricts flow and flexibility. Each force alone is manageable. Together, they are destabilizing. They emphasize that this is not visible in daily price action. Markets often mask stress through liquidity. Paper contracts can expand even when physical availability cannot. This creates the illusion that supply is abundant. But paper supply does not solder circuit boards. Paper supply does not conduct electricity. Paper supply does not build infrastructure. They explain that when these three forces align, silver's behavior changes suddenly. The market does not transition smoothly. It snaps. Adjustments happen faster than planning cycles. Costs reprice before contracts can be renegotiated. Business leaders often misinterpret this. They assume volatility is speculative noise. They respond late, after margins are already affected. They stress that silver is not just an investment concern. It is an operational one. Entrepreneurs who never touch commodities are still exposed through suppliers, manufacturers, and infrastructure costs. This is why silver matters to decision makers who believe they are insulated. They warn that convergence phases do not last forever. Either one force weakens, or the system rebalances violently. History shows that rebalancing is rarely gentle. They conclude that silver is entering a phase where silence is misleading. The lack of movement is not reassurance, it is compression. And compressed systems do not release energy slowly. They leave the audience with a critical realization. If three forces are pulling at once and supply cannot stretch, then the weakest point is not silver itself, it is the system relying on it. And the next question becomes unavoidable. How strong is that system, really? They slow the pace deliberately, because this is where most analyses fail. Demand stories are easy to tell. Supply stories are not. Supply is quiet. It does not trend on screens. It does not react quickly. And that is exactly why it becomes dangerous when pressure builds. They explain that silver supply is often misunderstood. Many assume higher prices automatically bring more metal to market. That assumption works for some commodities. It does not work well for silver. Silver is rarely mined on its own. Most of the world's silver is produced as a byproduct of mining for copper, lead, zinc, or gold. This means silver supply is not driven by silver demand. It is driven by the economics of entirely different metals. This creates a structural rigidity. If demand for silver rises sharply, miners cannot simply decide to produce more. They must wait for changes in other markets. Even if silver prices rise, production does not respond in a meaningful time frame. They emphasize that this is not a temporary issue. It is structural. Mining is capital intensive. It requires long-term planning, regulatory approval, and stable policy environments. New projects take years, sometimes decades, before they produce meaningful output. In the meantime, demand continues. They point out that recent years have discouraged investment. Volatile prices, rising costs, and political risk have made mining companies cautious. Capital discipline has replaced expansion. Projects are delayed. Exploration budgets are tight. This leaves little spare capacity. They explain that when spare capacity disappears, systems lose resilience. There is no buffer. Any disruption, labor issues, environmental restrictions, geopolitical tension, reduces supply immediately. At the same time, industrial demand does not pause. Factories cannot wait for new mines. Infrastructure projects do not stop because silver is scarce. Technology does not redesign itself overnight to remove silver. Instead, buyers compete. They describe how this competition rarely shows up first in price. It shows up in availability, longer delivery times, smaller allocations, Priority given to large buyers, smaller firms pushed to the back of the line. These are early warning signs. They explain that financial markets often mask this reality. Futures contracts, derivatives, and paper instruments create the impression of abundance. On paper, silver can be created instantly. Physically, it cannot. This disconnect matters. When confidence in paper claims weakens, physical demand rises further. Buyers seek certainty. They want delivery, not exposure. This increases pressure on already tight supply. They explain that once this shift begins, it accelerates. Each buyer worries about being last. Inventories move from distribution to hoarding. Liquidity disappears faster than expected. They stress that silver is not unique in this behavior, but it is uniquely exposed. Its small market size magnifies stress. Its industrial role makes shortages immediately painful. For businesses, this creates operational risk. They note that many companies do not track silver exposure directly. It is embedded in components, suppliers, and contracts. When silver costs rise or availability tightens, the impact appears indirectly as cost overruns, delays, or renegotiations. By the time it is visible in financial statements, it is too late to hedge. They explain that just-in-time supply chains make this worse. Efficiency has replaced redundancy. There are a few stockpiles, little slack. Systems work perfectly until they do not. Silver shortages do not announce themselves loudly. They ripple quietly through manufacturing networks. They warn that this fragility is often ignored because it lacks drama. There is no single headline, no clear villain, just a growing strain that decision-makers underestimate. They emphasize that supply constraints are not opinions. They are physical limits. They do not respond to confidence or belief. They respond only to time and capital. And time is the one thing stressed systems lack. They conclude Part 3 with a stark observation. When demand rises and supply cannot respond, markets do not negotiate. They ration. And rationing does not affect everyone equally. Those who prepared early adjust. Those who did not absorb the cost. Which leads to the final and most important question. If silver is quietly revealing the limits of the system, what happens when those limits are finally tested in public? They do not frame this as a forecast. They frame it as a consequence, because markets do not move without reason. When silver finally reprices, if it does, the move will not be about silver alone. It will be a response to pressures that were already present but ignored. They explain that silver has historically acted as a messenger, not the loudest signal, but one of the earliest. When monetary systems weaken, when industrial demand tightens, when policy distortions accumulate, silver begins to behave differently before the broader economy reacts. This is why its movements matter. A sharp adjustment in silver would not simply affect investors. It would expose stress points across multiple sectors at once. Manufacturing margins would tighten. Procurement strategies would be questioned. Long-term contracts would suddenly look fragile. They note that many businesses plan based on assumed input stability. Prices may fluctuate, but availability is taken for granted. Silver challenges that assumption. When availability becomes uncertain, planning horizons shrink, uncertainty spreads. They explain that a silver repricing often forces uncomfortable questions. Why did costs rise so quickly? Why were inventories insufficient? Why did hedges fail? These questions are rarely answered in advance. They point out that silver's influence extends into energy transition projects, digital infrastructure, healthcare equipment, and defense systems. These are not optional sectors. They are strategic. Cost increases here ripple outward, affecting budgets, timelines, and policy decisions. This is where silver becomes a systems issue. They explain that policymakers often respond late. By the time silver's signal becomes visible in inflation data or industrial shortages, corrective measures are already constrained. Rate changes, subsidies, or regulatory adjustments cannot create metal. They can only redistribute pressure. They describe how history shows a familiar pattern. Early signals are dismissed as niche. Mid-stage warnings are debated. Late-stage consequences are explained after the fact. Silver often sits in that early stage, visible to those looking, invisible to those relying on consensus. They emphasize that entrepreneurs and business leaders are not powerless here. Awareness itself is a strategic advantage. Understanding exposure allows for diversification, alternative sourcing, inventory planning, and contract flexibility. But awareness must come early. They warn that when silver moves suddenly, it compresses decision time. Choices that could have been planned calmly must be made under stress. Costs rise faster than adjustments can be implemented. They stress that this is not about fear. It is about realism. Systems built for efficiency struggle under constraint. Silver exposes those constraints because it is both essential and limited. They explain that the real risk is not missing upside. It is misjudging resilience. Businesses that assume stability where fragility exists often learn the truth at the worst moment. They conclude that silver's importance lies not in its price, but in what that price reflects. It reflects confidence. It reflects supply discipline. It reflects the balance between real demand and paper claims. When that balance breaks, silver does not whisper. It corrects. They leave the audience with a final strategic reflection. Silver does not cause economic stress. It reveals it. And when it does, the question is no longer what happened. The question is who was prepared and who was forced to react. They end with a quiet but firm reminder. In complex systems, the most dangerous signals are the ones that arrive early and are ignored because they arrive quietly. Silver has been quiet for a long time. That silence may not last.